This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in last time's lecture, we focused on assets that had private use by the proprietor. And what we saw is that for each such asset with private use by the proprietor, we needed to maintain a separate column on the capital allowances computation. They are non-pool assets. Each such asset represents, as it were, a pool in its own right. What we're going to have to see is whether we can put that theory into practice. You watch me do some examples with you last time, and here, as you can see on your screen, we've got example 2. So what we've got to do. Requirement: calculate Jane's capital allowances for the year ended December 19. So Jane, as we see here, prepares accounts to the 31st of December. She is the proprietor of the business. As ever, at the beginning of the period, we'll inherit tax written down values brought forward. On what? Well, as you'd mostly suspect, a main pool. So that will be one column that we need to set up on the CA computation for this period. What we then got, a motor car with 105 grams per kilometre, used 30% for private purposes by Jane. That therefore tells us this asset has private use by the proprietor Jane, and is why it has been kept separate in its own column within the capital allowances computation. So we've got those two columns set up at the beginning of the period. What we also know for transactions during the period, we'll run a little memorandum value column wherein we'll record any qualifying expenditure for AIA, for WDA, for FYA, whatever is appropriate. So let's see what we've got therefore, other than the value column in terms of recording those purchases during the period, the main pool column as we've seen here, the motor car with private use by the proprietor, and always, of course, what we have, the final column on the right-hand side of the page, to record the allowances available in the period. So what have we got happening during the period? On the 10th of May 19, purchased plant for 6,600. That, of course, is AIA, and its main pool expenditure. Not it's going to make any difference here whether it was main or special rate, because there is more than sufficient allowance limit, £1 million worth indeed, to absorb a mere 6,600. We'll get our 100% AIA. And then we've got a whole series of transactions in cars. A very likely outcome for you in your examination indeed. Probably the single most tested issue will be the purchases and disposals of cars. And when dealing with cars, we'll need to segregate out any such car which is likely to have somewhere within the question private use by the proprietor. So what we've got here, 25th of June 19, a car, £10,600, CO2 emissions of course is critical, 100 grams per kilometre, to be used by an employee. Now, if it's being used by an employee, any business stroke private use mix is irrelevant for capital allowance purposes. I'm not going to underline what it then goes on to say he will use it 80% for business purposes, because that doesn't matter. The fact again that a business with an employee provides a car for the use of that employee for both business and private purposes, that is something that we'll see in Chapter 9. That is an employment income assessment. It's an assessable benefit. The idea of, inverted commas, a company car there being provided to an employee. That is an assessable benefit. That is employment income. So there's no restriction to the business itself in terms of the available capital allowances. So all we need to know there, therefore, is where will it go? 100 grams per kilometre, and that therefore means it's a main pool item. It's main pool, but of course, unlike the first one, the plant, which was and indeed is eligible for AIA, this is a car, and therefore as it's not a low emission car, it's WDA. On to October 19, sold the car used privately by Jane for 9,400. So this one that we had inherited at the beginning of the period with the tax written down value of 13,600 is now being sold for proceeds of 9,400. Very clearly, therefore, those proceeds are less than its tax written down value. And when we sell off what is a non-pool asset, and we're going to sell it at other than the tax written down value, here for less than the tax written down value, a balancing adjustment will arise to clear out any remaining capital allowances or to claw back the fact that we've had too many capital allowances over the period of ownership. When we compare what we originally bought it for, the costs that went into this computation, with now the proceeds. Have we taken too much or too little allowance over the period of ownership? Here we've sold it for less than tax written down value, so we have not claimed sufficient capital allowances during our period of ownership. What does it mean? We'll get a balancing allowance there. But of course, remember, when we do that, when we show it on our computation, we have the fact that this was 30% private use, i.e. only 70% business use. And that means, therefore, that we're going to have to restrict the available balancing allowance to just the business use proportion. More of that in a moment. On the 16th of October 19, purchased another car, £16,000, this time CO2 emissions 180 grams per kilometre. So we now know we're talking about the reduced writing down allowance. This one again used privately and by Jane. So we've got a new non-pool asset. We'll close down the old non-pool asset, the original car, with a balancing adjustment computation. We'll then set up, we'll need to leave space of course on our computation for a new column now, which will be this particular car that again has business use, private is 30, so business use 70%. So our initial analysis therefore is vital before we start to, as it were, put pen to paper there, or in the exam fingers to computer keyboard. So what do? We know that we start with setting out what columns we need and bringing forward any opening tax written down values. We know that we're going to have the main pool and the non-pool asset that we owned at the beginning of the period, the original car, 105 grams per kilometre, with their own separate columns. We also know that here we have bought a new such car with private use by the proprietor, so we need a separate column for it. We also need the allowances column. We can then bring forward the tax written down values, add in the additions, firstly that rank for AIA, take the AIA. Then those that rank for WDA, those are the cars here that we have bought. We then deal with any disposals. We have here a disposal of the original car with private use by the proprietor, so that, as we've said, will give rise to a balancing adjustment. Okay, now if you think you can take that on at this particular point in time, which I hope you can, then do pause at this point, because what I'm now going to do is to go to the answer and see how what I've just said manifests itself within that capital allowances computation. But again, not a bad idea if you could do that for yourself now, if you feel up to it, rather than just watching me take you through that. So you will go first and then come back and see what we now do. Otherwise, stay tuned and we'll now look at that answer. So, as we said, set up the computation for the accounting period, here the year ended December 19. Leave the space, of course, for your recording of any transactions during the period there. And then we can put them into their relevant columns. We've got also the main pool brought forward, the original business stroke private use car. We know we bought another one during the period, and then we've got our allowances available column. So we know which columns to use. Pick up the tax written down values brought forward as given in the question. Then deal with additions that qualify for AIA. That is a single item of plant for 6,600. Obviously we get the 100% AIA, and that goes over into your allowances available column, and there's nothing to go into the pool. Other additions, 2 cars. We had a motor car at 100 grams per kilometre that had, yes, private use, but by an employee. So there's no private use issue for capital allowance purposes for the business, for the proprietor here. Because of the CO2 emissions being less than 110 or not more than 110 grams per kilometre, then we place that figure into, of course, to the main pool. The other motor car was 180 grams per kilometre, but that's why we set up this column here. It has, again, private use by the proprietor. So into its own separate column, £16,000. We've dealt now with all of the additions eligible for either AIA or WDA. There were indeed no other additions there. The only other thing we could have seen was yet another car, which of course had low CO2 emissions, and that would be dealt with after dealing with any writing down allowance, any balancing adjustments in a separate FYA calculation at the bottom of the computation. It doesn't happen here. Take out the disposal. Remember, when we deal with the disposal, we deduct sales proceeds to a maximum of original cost. Very clearly, given that the tax written down value brought forward that we had up there was 13,600, it would have cost a whole lot more than that. So the disposal consideration, as you'd expect, the sales proceeds, significantly lower than cost, and that is the figure that we deduct. And that gives rise to a balance still on that pool of 4,200. And that will be the basis, of course, then, for your balancing allowance calculation. It's a balancing allowance. We're left with a positive balance there. We have not taken sufficient allowances over the period of ownership. We make up for that with now a balancing adjustment, a balancing allowance on this disposal. The problem is, of course, that it has private use by the proprietor. So, like we would restrict a writing down allowance, which we'll see on the replacement vehicle in a moment's time, so too do we now restrict this balancing adjustment to the business use component. Multiply it out, and hopefully that's the available writing down allowance we get. Sorry, the available balancing allowance that we get, I beg your pardon. In terms, however, of writing down allowances, at 18% on the main pool, straight calculation, hopefully using the calculator correctly, and we put that into our allowances column. That leaves just one further computation to do. Our new business stroke private use car, £16,000 in its own separate column. Its high CO2 emissions, so the writing down allowance is limited to 6% there. That 6%, again, restricted to the business use proportion, which again is 70%, and that then we record the WDA. Add it all up, we've got our capital allowances for the period, and that in turn, if required, would be deducted from the adjusted trading profit to give you the tax adjusted trading profit of this accounting period. Okay, do make sure again that you're happy with that. These are typical transactions that you would have to deal with in terms of an examination question. The only other thing, as I say, I could have added in there would be to have put a low emission car in, as well as cars, as you've seen, with emissions between 51 and 110 grams, and then in excess of 110 grams per kilometre. We could have had a low CO2 emission, one that doesn't exceed 50 grams. That means that after having computed the writing down allowances, the balancing adjustment, instead of then carrying forward those tax written down values as are, not that they'll change, we would then list out the additions qualifying for FYA, i.e. the low emission car, and take the 100% FYA there on. Okay, have a pause for a moment and again check through, go back if necessary through the earlier notes before we move on. We're in the realm of non-pool assets. We've dealt with the main category, by far the most important, assets with private use by the proprietor. The next one that we're going to look at, it's a bit messy. It's called short life assets, as we'll discuss when we deal with that in a few minutes' time. It's really not something now with an AIA limit of £1 million that ought to be, in practice anyway, an issue. But of course, it is something that could still come up. Examiners can use whatever numbers they like And of course, numbers for a company, when you do the equivalent exercise for capital allowances for a corporate tax problem, well, there may be a lot bigger numbers, and then we might see this short life asset issue coming through. We'll explain that in the next part of the lecture. Now, when it comes to non-pool assets, we've seen that there are two categories. We have now dealt with by far the most important category of non-pool asset, i.e. those assets with private use by the proprietor. Again, of which the most likely asset to have private use by the proprietor, a car. And that then gets you into the idea of the CO2 emissions, and therefore to know exactly what allowance would be available thereon as regards, is it a WDA of 18% or is it a WDA of 6% under the current percentage rules there. Now, when dealing with those assets, there was no choice as regards the taxation treatment. It was a non-pool asset. You must keep each and every such asset separate. And the reason why we did that was we would then limit any writing down allowance and potentially on disposal any balancing allowance. Obviously, it would equally apply in terms of a restriction of a balancing charge as well. So we had to keep it separate because we would limit the available allowances to purely the business use proportion. Now, what we see here is not a rule that says you must do this in relation to something called short life assets, but this is an election that is available to the taxpayer, to the business there. And obviously, we're only, as a taxpayer, going to make an election if it improves our tax position. So important to know, therefore, the sort of situation that you would be in which you would choose to make this election. A choice, indeed, these days that is incredibly unlikely, certainly so far as an unincorporated trader is concerned, and we'll explain that in a moment. First of all, just to say a little bit about it. Now, we said already it's an election. And we're choosing, it's a de-pooling election, to omit a short life asset or assets from the main pool. This particular de-pooling election pertains only to assets that would otherwise have gone to that main pool. You remember, of course, there are specific categories of assets that go to special rate pool. And we also have motor cars, of course, where no AIA is available, only a WDA is available. Now here, as we'll discover, any plant and machinery that would normally go to the main pool would be available, except cars. Short life. If any asset is going to have within your business a short life, it's probably going to be a car. But we don't get the ability to make a de-pooling election in relation to cars. That's the one exception. Any other assets that would otherwise go to the main pool, you may choose indeed to make such a short life asset election. And can be treated, therefore, as a short life asset. So you're leaving them out of the pool. You're choosing to separate it out. You're making more work for yourself here in relation to the capital allowances computation. There must be a reason, therefore, to include any such asset in its own individual column and make this de-pooling election. Now, the idea behind it, if it's going to be valuable to the taxpayer to do this, is it would allow the acceleration of capital allowances on short life plant and machinery where they are sold at a low residual value. And we mentioned, of course, what do we mean by short life? Well, there we go. If it was scrapped within 8 years following the end of the accounting period in which it was acquired. Indeed, as we'll see, what we'll get is an asset that is sold within that 8-year period. That is the term we mean by short life. It's not that short, is it? Capital allowances on each short life asset are calculated separately. And the idea behind it, what we're looking at is an asset that would have gone into the main pool. So most plant and machinery that would otherwise go to the main pool won't actually end up in the pool, because when we buy it, what do we get to claim? We get to claim AIA. And what is the AIA limit now available to us? £1 million. It is therefore incredibly unlikely that any unincorporated trader, at least, is going to have such main pool expenditure in a 12-month accounting period that exceeds £1 million. What it will mean, therefore, is if you get your AIA, you've had 100% relief. The whole cost immediately relieved against the trading profits of that period. That's as good as it's going to get. This election is only going to come into play if you have expenditure incurred for an accounting period, main pool expenditure, that is in excess of the AIA limit. And in those circumstances, it may be seen to reserve the AIA for the other main pool expenditure, and any expenditure that was incurred on short life assets, those with a life of less than 8 years, we would think, and also, importantly, those that we anticipate will have a low residual value. Then let the other assets take the AIA, and then, rather than this residue of expenditure where short life assets exist that hasn't ranked for the 100% AIA, make the depooling election. Now, initially, when the depooling election is made, and while you continue to own the asset within the depooling election column, the short life asset, there's no difference. You will get a writing down allowance. Rather than it being a part of the pool and getting your 18% WDA, you've separated it out and you give it specifically the 18% WDA. Like within a pool, you get a tax written down value to carry forward, and on a reducing balance basis, 18% per annum on that reducing balance basis. So again, all it seems to be doing is to make more work for yourself. The reason why we do it is, as we've said, it's going to have a short life, and it's likely to have a low residual value. And it is equally one that is not ranked for AIA when we bought it. The expenditure that we've incurred has gone above the AIA limit of £1 million, most unlikely we've suggested, and therefore we've given the AIA to the other expenditure and chosen then to make the short life asset depooling election in relation to this short life asset. And the reason why: when a non-pool asset is sold, what do? We bring forward the tax written down value. We are anticipating now a high tax written down value because we'll have a year, 2, maybe 3 years. It's usually not a very long life where we make this election. We'll have a relatively high tax written down value and a low residual value. So when you deduct your low sale proceeds from the much higher tax written down value, what is going to arise given that it is non-pool? As you've just seen in the previous example, a balancing adjustment. What type of balancing adjustment? Sales proceeds much lower than the higher tax written down value. That's a balancing allowance. And what it means is that we are now able, when that short life asset is sold, to pick up all of the remaining capital allowance that would be available on that asset, so as to fully compensate us at that point of sale for the net cost of the ownership of that asset to that point of sale. Now you might say, well, okay, but how is that different to putting it in the pool? It's very different. If we had immersed, dare I say, that asset within the pool, and we'd been claiming a writing down allowance of 18% on the whole pool balance, that asset included, then when that asset was sold within the pool, it's got a high tax written down value, now it's sold low proceeds. What would happen? You take away your proceeds from your pool and you don't get a balancing adjustment. You simply get another 18% writing down allowance. And what would happen is that the residue of that expenditure would remain unrelieved within the pool for you to pick away at year after year after year 18% per annum on a reducing balance basis. This system, by making this election, allows you to collect all of your available allowances within the lifetime of ownership. At that point of sale, you'll be fully compensated for then the net cost that you have incurred. Again, however, as we've said, and I'll go to the last point, or one of the last points here, is that given the amount of AIA available at £1 million per annum, it is very unlikely that the election would now be worthwhile. It's unlikely that the election would be worthwhile for most unincorporated traders. Why? Because if you've had AIA, you've had all of your tax relief. There's nothing else to give. All that would happen in those circumstances is you generate for the sales proceeds when sold. If you had separated it out, you would have a balancing charge. Nobody's going to do that. So it's only in these circumstances that you will be considering making the depuoling election for the short life asset. The total expenditure for, let's say, a 12-month accounting period that would be eligible for the main pool is in excess of £1 million. And within that total, there are one or more short life assets that you believe that you have acquired. And not just that they will have a short life, but as we keep saying, they'll have a low residual value. In that situation, allocate your $1 million AIA to the other assets there and separate out the short life asset or assets. You'll only have one to deal with here, and make the depuoling election. Put it into its own column. As we said, while you continue to own, whether in the pool or separate, it's the same writing down allowance. But when you sell that asset, there is a specific balancing adjustment, which we anticipate to be a balancing allowance. That is the prize. We get the balancing allowance at the point of sale. Okay, back to the notes before we then do an example. On disposal within 8 years of the end of the accounting period in which the acquisition took place, a balancing allowance or charge arises. Now, yeah, we are going to have a balancing adjustment, but we'd only be making this election if we knew that not only short life, but also low residual value. A typical example, therefore, here would be something like computers, where again, they are probably going to be 3, 4, maybe 5 years, but 3 or 4 years shelf life. And again, they're then much slower than the current ones available. You need the most up-to-date in the business. And what's going to happen in terms of that now 3, 4, 5-year-old computer? Nobody's going to want it. You might give it away to charity or something like that, but very little, if any, residual value. So a typical example there. Again, though, we'd be only making this election if in the accounting period when bought, the expenditure levels had gone over what was the AIA limit. Currently very unlikely, as we say, because it's £1 million. Clearly, as we said, the election would only be worthwhile if a balancing allowance was anticipated. Now, I don't think it's going to be an issue for you, but we made the depuoling election. Transpires, we don't actually sell. We keep. So if no disposal were to take place within 8 years of the end of the accounting period in which the acquisition took place, the unrelieved balance would be transferred back to the pool. Again, not an issue I think we need to worry about. We know, as we said, that it's main pool expenditure and upon which AIA would be available. If expenditure is outside this limit, then the expenditure on the main pool items will qualify for a writing down allowance of 18%. The AIA could be matched with short life assets. However, if total expenditure on plant and machinery is above 1 million, as we have just been saying, the AIA would be allocated to the main pool additions first, as no balancing allowance occurs on sale. If the AIA is allocated to main pool items first, then a short life asset election could be made on any short life assets, again with balancing allowances crystallising on disposal. So only to repeat for the last time, sorry to keep repeating, but just so you can get your head around this, we're only going to consider making the claim where expenditure is in excess of the AIA limit, and we have within that total expenditure that would rank for AIA and B main pool, we have what we recognise to be a short life asset and one with a low residual value. That is the one to be separated out and kept in its own short life asset column. Now, an issue. An exam question may still be set, of course, for an unincorporated trader selling a short life asset where the election has been made. We haven't always had £1 million as the AIA limit. Immediately before this, it was £200,000. It has been as low as £25,000 in years gone by. So it may have been and would have been far more prevalent in years gone by. So what may happen, therefore, is you may pick up at the beginning of the accounting period what is an opening tax written down value brought forward of a short life asset. Now, what is going to happen, therefore, in relation to that asset this period? It's going to be sold, and most likely, as we'd expect, sold for a much lower figure of sale proceeds. So you're not making the decision in your exam question, do we, don't we make that election? That decision had already been made in years gone by. Maybe sensibly then, because there was insufficient AIA to cover all the expenditure incurred in that particular period. And what we're now doing is to see that within the up to 8 years, within that period, following that purchase, we inherit at the start of this accounting period its individual tax written down value brought forward on this short life asset. Now it is sold. As any non-pool asset, tax written down value brought forward, less those proceeds, and you get a balancing adjustment. The probability, the only sensible outcome would be that the proceeds are much lower than the tax written down value, and therefore a balancing allowance arises. That's why we made the election in the first place. Now, again, if we're looking at expenditure now, it's hard to think that we're going to get expenditure in excess of £1 million. But given that the same rule here for short life assets applies for companies, in companies, of course, capital expenditure on plant and machinery in a 12-month accounting period in the bigger companies may very well exceed £1 million, in which case, therefore, it is still a distinct possibility that in a corporate tax problem you might have to deal with, as in practice, the short life asset election. And that's what we're going to see now in example 3, where we've got to calculate the capital allowances for the years ended 31st of March 20 and 31st of March 2021. What we're going to see is both the purchase of and then subsequent disposal of a short life asset. John, our hero here, prepares accounts to the 31st of March in each year. At the 1st of April 19, the beginning of the year ended 31st of March 20, the written down value of the main pool was a mere 16,000. Is that 16? Can't even see that there. Oh, wrong. Let's have a look. Yeah, a mere £16,000. On the 1st of July 19, John purchased machinery for, it's an unlikely proposition, is it? £1,020,000. I've got to go above 1 million to get this short life asset election being worthwhile. On the 1st of September 19, John purchased a photocopier for £40,000 and made a short life asset election. We're going to see why, because in the next accounting period, to be precise, the date of sale, the 1st of July 2020, the photocopier was sold for £15,000. So, what we've done, we've made, as shown here, the short life asset election. We've reserved the £1 million AIA limit to be used firstly against the machinery there at £1,020,000. Obviously, we'll get £1 million out of the £1,020,000. The other 20,000 will go into your main pool. And the £40,000, the photocopier, doesn't go anywhere near the pool. It has its own separate short life asset column. In it goes for 40,000. There's no AIA available upon it, and therefore we get WDA. That will be what happens within the year ended 31st of March 2020. We'll go on to the year ended 31st of March 2021, where it will be sold for a mere £15,000, which will be much lower than its then tax written down value. That would be the original cost of 40,000 less just one accounting period's 1 year's worth of 18% writing down allowance. What will that give rise to? It'll give rise to a balancing allowance. Hence the point of the exercise. You've now managed at that point of sale to get all of the remaining allowances due to you to compensate you for the net cost of ownership of that asset. Let's have a little look therefore at how that manifests itself in terms of an answer. Now again, as ever, if you want to have a go at this, absolutely fine. In fact, I would encourage you to do so. See if you can do it for yourself. You'll be a lot stronger for that. If not, then let me take you through now the answer to that and see how we get it. Okay. Example 3. Again, 2 accounting periods to deal with, March 20 and March 21. What are we told? Main pool, 16,000, is your tax written down value brought forward. As ever, a value column in which to record the purchases, and because they're so big here, that's in thousands of pounds here as we'll record it. We know that we've got a short life asset, the photocopier, that is going to be kept separate to the pool. We make the depooling election. So we set up its column. And we know we need to record all of the allowances for the period. Tax written down value brought forward, additions then qualifying for AIA. The machinery at 1,020,000, the photocopier at 40,000. We make the depooling election for the photocopier, so it is going to be separated out there. The maximum AIA of £1 million would be allocated to the machinery. That 40,000 is going nowhere near the main pool. Oops, apologies for that. I'm the one who forgot to put his phone on silent. You wouldn't want to be next to me in the cinema, would you? So my apologies there. Right, now that the rude interruption has disappeared, let us continue with the answer to this particular example. I think when we were rudely interrupted, we had determined that because the total main pool expenditure incurred this period was in excess of 1 million, the AIA would be limited to that 1 million, and that on a £1,060,000 total expenditure would mean that £60,000 would only then rank for writing down allowance. So what have we done? We've immediately taken 40,000 of that expenditure and made the depooling election, treating it as this short life asset. That's left only 1,020,000, therefore going into the AIA calculation, of which we restrict to the maximum 1 million. That puts £20,000 of the machinery cost into the main pool. The 40,000 in the short life asset column. The £1 million, of course, the capital allowance, the AIA available. Right. Anything, of course, that was tax written down value brought forward, or expenditure that was not qualifying for AIA because we were above the AIA limit, goes into the pool. We've got 36,000, and of course on the main pool we can have 18% allowance. What we've then got is our short life asset, again the WDA because it would otherwise have been main pool, 18%, and we take our 18% on that, and again those allowances will then be added in to the allowances for the accounting period as a whole and get your tax written down values to carry forward. And when we go into the next period, we don't have to wait long, of course, for this short life asset to live up to its name and to be sold, because in that next period, bring forward our tax written down values, no further additions, but we do have the disposal of the photocopier for sale proceeds of 15,000. Leaving a residue of unrelieved expenditure in relation to what did it originally cost and what have we then sold it for, a residue of unrelieved expenditure of £17,800 there. Therefore, we are now able to claim all of that £17,800 in the form of a balancing allowance. When that non-pool asset is sold, we clear out any balancing adjustment. Again, remember, the whole point about this exercise, you'd only make this election if you knew it was going to have a low residual value as well as the short life. We've still got, of course, what was within the main pool, and as ever, that's 18%. That hopefully the calculation to be done. Put the two figures in, get your allowances, and that will be the allowances for the period. Okay, have a look through that, have a think about the things that we have said. Do bear in mind that although some of the issues here on short life assets can be problematic, the issue of non-pool assets, by far the most important one, and very, very likely to be tested in any Tax UK exam, is where you're dealing with assets with private use by the proprietor. Make certain that you focus on those. Don't get too worried about the short life assets. If you see it at all, probably all that will happen is you don't have to make the decision about a short life asset. The election has already been made, and you inherit at the beginning of the accounting period for which you have to prepare the capital allowance computation, a tax written down value brought forward. And what happens is it is then sold. The likely sales proceeds significantly lower than the tax written down value. But whatever they are, you compare those proceeds with the tax written down value and a balancing adjustment arises. Again, by far the most likely a balancing allowance. And that's it. In a corporate tax question, it is possible, given that the companies may be spending a lot more than an unincorporated trader may spend, that you may have expenditure, like here, that goes over the 1 million. If so, and they've got to tell you the life of this asset, it's going to be short, they may even say that you intend to make the depooling election in relation to the short life asset. What do? You get your AIA to your maximum on the other main pool expenditure. This asset, or assets, goes into a separate then non-pool column for that short life asset, and you take your writing down allowance there on, carry forward the tax written down value. Those are the outcomes you're going to see. Okay, as ever, go back through, review all that we've done during this particular session before then coming back to us, and hopefully we'll be able to finish off our capital allowances in the next lecture. See how it goes. Look forward to seeing you then.